Hey everyone, welcome to another Market Radar podcast. We have concluded a pretty big week. We had FOMC and GDP. So let's get started. GDP came in hot. It affected bonds. We'll talk about that and what bonds are telling us based off of how they've been moving lately. And we had FOMC, which went pretty much exactly as we expected. So let's get right into it. So the way I gathered it, Powell comes out, he does his 25 basis point hike. It was more of a credibility move. They really didn't need to do it. We're kind of at the point where the duration of these elevated rates matter more than any further rate hikes. It doesn't matter if he hikes 25 basis points or 50 or 75. It really doesn't make a difference at this point after hiking already 500 basis points. So we're now at the point where they just need to hold rates. And Powell knows that. And that's exactly what he was saying in the presser. He got a lot of questions, people asking, will they be cutting soon? Are they going to hike further? And he doesn't want to give off any hints on that. He knows that the market reacts to everything that they do and say almost instantaneously. It's not like how it used to be with newspapers and slow reaction. There's robots placing trades now. We're in a much faster pace environment today than we were back then. And Powell knows this, the Fed knows this, and so they're not going to hint at finishing their hiking cycle. They're going to leave the door open, which is exactly what Powell did. He left the door open. He said there's going to continue to go data dependent. He didn't say anything about rate cuts. In fact, he said they're not planning on cutting until 2025, which is when they expect inflation to return back to 2%. And I think that's an over-exaggeration, but that's exactly what he wants to do, because by saying that has a tightening effect as well. Whereas if he were to come out and say, yeah, I think we've got inflation under control, we could possibly think about cutting rates pretty soon, that's going to have an easing effect and cause inflation to rise just because of that. If everyone knew they're going to be cutting soon, they're going to act based on that information, and that is going to have an easing effect on the economy. So that's how I gathered it. Gamma, what do you think? You have anything else that I might have missed?
So I do think that obviously Powell got a bunch of direct questions in terms of when, number one, since inflation was going down, why did he hike again? Number two was when they expect the emergence of more a much looser policy compared to where we are right now. And number three was, will there be a recession? Right. So let's go over number one. Powell basically is in a position right now where he has to, as you said, Artie, maintain composure as inflation is on the way down. And the entire Fed has laid out this framework where originally, Wall Street has a very narrow mind when it comes to how things have happened and how things will happen again. And that narrow being short, right? They remember the Fed being the one of transitory, right? The Fed was this transitory figure. It's only transitory. It's going to come back down. And inflation theoretically is transitory in the United States because the Fed is the opposing force in that inflationary fight. In a country like Argentina, inflation is indeed very not so much transitory. Now, you can argue, oh, well, we have perpetual inflation in this country and pretty much every country in the world. Yes, that's normal. I'm talking about over 2%, something that's seen as abnormal, especially based on the current central bank standards. But let's get back to why Powell basically had to hike when inflation is on the downswing, right? Inflation is indeed a transitory measurement. If it goes sideways, it flatlines. It goes back towards it's a mean reverting indicator. So it's on the downswing, and Powell now is put himself in a position where he was this transitory king. Everything's transitory. The effects are transitory. You even heard him bring this up in the press conference this week, where he was mentioning the supply chains easing up from COVID, assisting in the return to a normal territory of inflation. And that's something that obviously they were hinting at for being a main cause or driving force in inflation early on in the fact when inflation was rising, and they kept claiming it was transitory with peak here, peak here, peak here, and it never did. Obviously, it proved them wrong so many times before it actually peaked. And they now are in a position where their projections have to be something of seriousness. They've basically, the Fed was a main driver, and look, you can blame Ukraine, blame whoever you want. Fed caused inflation.
Yeah. So now they're
Theoretically,
in
the
a
government, right? The
yeah.
government and the Fed through all this money printing and stimulus. So the Fed has, call it like a little bit of a shit stain on his tie, right? They want to fix it.
Yeah,
So
they got to rebuild that credibility after they messed
right.
up so hard.
And in their minds, they never lost their credibility because the Fed is all knowing in the economy in terms of what to do, right? They're making it very clear that they don't know where inflation's going. Powell literally said that one data point doesn't mean much. We want to see the trend go lower. And headline has been going pretty much straight down. And he's still hiking. Now, a lot of people are saying, oh, he doesn't want to cut because he doesn't want to repeat 1980s or late 70s, early 80s. And we're not even talking about cutting. The Fed is in a restrictive policy stance, restrictive enough to where they can hold. And they'll just remember this. Powell literally said that they have not seen the full length of their policy take place yet. So he's implying, which as we all know, there is a lag in Fed policy. Now, just like how inflation was transitory and all that garbage, they're going to play this trick now. The lags may not be real. The lags might not be what they think they are. As they always do, there's always some hopium in the pipe or a light at the end of the tunnel that they can like spew a unique scenario every single time. It's almost like every single time is so unique that it has its own spot going forward in history, right? Like this time is so different, it will not compare to the past. Yet that's every time going forward, meaning that every time going forward is so unique that the past is no longer relevant, right? And that comes up with everything, with inflation, with unemployment, with at one point before inflation, it was MMT. Oh, during COVID, oh, MMT is possible. We can run this. We can run this forever. And yeah, little do they know the rooster came home to roost, and here we are now with dealing with inflation. Long story short, everyone likes to look at the situation, find an anomaly, and make this the most important segment of any time prior in history. Right? Everyone likes to say this is the most important FOMC meeting of ever. It's always something, right?
Yeah, well, this one though was, I would say, the least important FOMC we've had over the last 2 years, because
100%,
they were really
100%.
in a position where it didn't matter if they raised this time.
It didn't have to, but again, this goes back to why Powell raised, right? This was the number one thing that came up in the press conference. The reason Powell raised is real simple. Everyone that places their, obviously this is a voting process, right? Everyone places their votes. It's not Powell. Powell doesn't come in and say, you know what, we're doing this and it's done. I mean, obviously the votes tend to be unanimous most of the time, right? I mean, obviously there's some debates. Actually, excuse me, I shouldn't say that. There's a voting process. This time it was unanimous. They can vary, right? And they tend to have open discussions regarding what they're going to do with policy, as it's a communal agreement. Now, they basically laid out that they think that if the economy does X, Y, Z, they should hike two times more by the end of the year. And Powell wants to stick with that because at the end of the day, he basically set himself up for the backdoor trap. What do I mean by that? Inflation was coming down well before Powell made the prior SEP statements of having to raise rates twice more, right? Inflation's been coming down. Financial conditions are generally tight in terms of in terms of you can do like lending, housing, all these things are tight in terms of the ability to gain to access credit, right? Because rates are higher. Makes sense. Now, there was no reason to make this adjustment of expecting that they should raise 2 times more, but they made it, right. They said, you know what, they want to stomp inflation out for good. They're going to fight the good fight, long story short. So they put out these projections, and the markets continues to fall. And now they're in this position where they're like, well, shit, we put out these projections, and the market, and not the market, I mean, inflation continues to come down, and real policy rates are still very elevated. So, which means expectations, therefore, of inflation remain anchored. So they go, well, at this point, is inflation really, or is the economy really going where we want it naturally, or did we now influence it by what we said? Meaning, what the Fed, they backdoor themselves to the point where like they have to hike now. I thought that they would be smarter than this. I thought maybe they made a mistake on the estimates, but based on how Powell presented himself and basically words from the committee in this last meeting, it's very clear. I didn't think they were going to hike. I got that wrong. It happens, part of the game, right? But it's very clear now that Powell is going to basically stick to the projections regardless, because he's afraid that the way inflation has moved will now be influenced by removing the additional restrictiveness. Whereas
Right.
inflation was already moving in that direction, but they may have to make a statement. Now they believe that statement has something to play in the path of where inflation's going. So it's almost like they stepped in front of the train and now have to kind of step aside, or they're going to get hit by it, and they have to step aside and just say, look, this is what we're going to do. And meanwhile, they never had to be on the tracks in the first place, but they wanted to be basically they wanted to inject themselves into the rodeo, and that's exactly what they did. And now this is what we're dealing with. Now, that's a little bit, I mean, obviously that's very complex for a simple thing. The Fed is just being the Fed. It really comes down to one thing. They are a lagging institution. They recite lagging data. They like to look at data in a direction of where they want to see things be proven before they take action. The problem with that is, as these things are being proven, it's usually because they've already happened, right? The data they're looking at lags. If anything, I'd say that the data of the least lag that they look at would likely be weekly jobless claims and break-even inflation rates. I think pretty much everything else, the unemployment rate, all these things are lagging.
Yeah. Well, and Powell even came out and specifically said they look at real yields. And
oh yeah, that was funny.
Yeah,
we've been talking about that for a while now, right? And
he
basically came out and confirmed it.
Exactly what we've been saying, and that's exactly what
let's look at them.
So yeah,
what this is.
This shows how restrictive they are. That's basically bottom line. This is where they are. So this is the effective federal funds rate minus the 5-year break-even inflation rate. And so right now they're at 2007 levels, when they were also trying to cool the market down before 2008 happened.
Right. So let's go over what this chart actually is telling you. So what this chart is telling you is it's portraying a rate that the Federal Reserve has if forward inflation expectations were to be accurate for the next 5 years. Meaning, over the next 5 years, if the Fed held their rates and inflation expectations came in as they were, or as they're expected to be, the Fed would be at 2.81%. We're now higher, since on TradingView hasn't refreshed yet for the FOMC meeting. Over 300 basis points of positive delta against inflation. So the Fed is basically 300 basis points above inflation over the short-term inflation, or short to medium-term inflation expectation landscape. Now, why is that important? Well, the fact that the Fed is above the inflation rate basically means that there is no reason for them to continue hiking. And let's go. Let's bring that elephant into the room that everyone likes to talk about: 1970s, 1980 inflation, the 1973-80 inflation event. Right? What they get wrong when they bring this up is the Fed cut way too quickly with inflation coming down the first time. They screwed up. Okay.
Right. And that's kind of the position that they're in now. So obviously if they cut now, they would put themselves in a similar situation. Even though
Right.
inflation has come down quite a bit and the Fed funds rate is above the inflation rate, which historically that's what you need to do to beat inflation. But now,
Realistically, there's a good argument, though. Realistically, there's a good argument that in the late 70s, early 80s, obviously outside of the oil issue that we had, which the Federal Reserve, they eased too quickly and they loosened policy too quickly. And it allowed basically inflation, people to get the idea that the Fed was not serious about tackling inflation. Okay. So if the Fed would have held rates at the peak, at the first peak before the second peak in that time period, or the peak before the final peak, I should say. I believe there was a peak prior, but long story short, the peak before the final peak, if they would have held rates there as inflation fell and remained a bit stiffer on it, they likely would have not had a scenario where they were desperately chasing inflation within the next few years. Probably wouldn't have happened. Now, inflation would have came down quickly, just as we see it coming down quickly now. But remember, it's very easy when the Fed is so restrictive, as you can see on this chart. Restrictive, first off, the pace of which they went from, they've never done this since 2003 in terms of, and the reason this goes back to 2003 is because that's when break evens began trading. This is a break even based spread, so we're limited to the scope of the existence of break evens. Long story short, though, this is the fastest acceleration pretty much ever in this data set. So this in the last 20 years, the fastest acceleration, right? So the Fed went from the least restrictive to the most restrictive in about a year. Now, of course, inflation is going to come down with that, but there's a difference between getting inflation from 9%, 3, 4%, and then from 4% to sub 2%.
right.
Right?
And that's where the duration comes in.
Exactly.
And that's exactly what they're planning on doing. So I think the way that this is going to play out is the Fed is going to stay at current levels. You know, they might raise another 25 basis points or cut 25 basis points. I don't see why they would cut 25 basis points. That wouldn't really make a difference, but they're going to remain roughly where they're at today and keep it there until something breaks. I think that's their plan because they don't know when something's going to break. They know there's a lagging effect, but they have no idea what's going to happen once these effects take hold. And so I think that's their game plan is they're just going to keep them where they are. They're going to continue with this hawkishness, you can put it that way, of not signaling any cuts and kind of leaving the door open for more hikes. I think they're just going to continue with that because that alone has an effect on the market just by doing that as well. And they don't actually have to make any real policy decisions by doing that. And then just hold it until something breaks. Is that what you think is going to happen as well?
I think, yeah. So I think that there's obviously the scope to be had here of like what the soft landing actually means, right? And the soft landing, pretty much, as we've gone over multiple times, means that the Fed is basically able to rein in inflation without creating a recession, right? That's really what that is.
Yeah, which is
So,
impossible.
well, I mean, yes. I mean, theoretically, I believe it's happened once or twice, but not with the same dynamics that we're seeing now in terms of what the Fed has what the Fed has just done, and basically the duration in which they're going to hold it. These are things that are unique to the current situation. But let's go back to how the soft landing plays out. I do believe the soft landing is impossible in terms of executing it now, as you agree as well, right? So we both agree that the soft landing is impossible to execute. Number one, it doesn't mean that the soft landing can't be played out temporarily. Remember, the soft landing being impossible doesn't mean that it can't essentially seem true, but then fail. And number two, soft landing being impossible also does not mean that you should be long bonds, right? The soft landing is impossible, and the way that we phrase that is the soft landing um, will continue until all faith in the hard landing is lost. And our marker for that all faith being lost in the hard landing and that final domino is the Fed. When the Fed starts hinting at the acceptable probability that they've achieved a soft landing, that's when we've gone too far. Not saying we're getting close. He's not saying anything like that. And I think that there's this interesting market dynamic we have that not to say that we can't at some point be long bonds and or gold or long equities, vice versa. But the way the soft landing is going to play out is as it has been, right? People are going to think that the soft landing is not real, then everyone will believe it's real. And once everyone believes it's real, just like everything else, the rug gets pulled. Problem is, the duration for that belief to become true is quite extended due to the immense lag that we're seeing in Fed policy. The Fed is, again, based on our real Fed funds rate is now, what with the new Fed funds rate is now over 300 basis points. A year ago, go back to July of 2022, we were barely at zero. So you have to understand, it's like I'm sure you guys know there's fighter jets that pretty much can lift off and go vertical, right? That's literally what the Fed did. You're looking out on the runway and you don't see a plane. You're like, oh, no problem. There's no plane here. Meanwhile, the plane took off 100 yards back and went straight up, right above you. Target's locked on you. You don't even know. That's what's going on right now.
Yeah, and in 2007, they were at these restrictiveness levels for over a year. So
Right.
placing a trade, so if you go long bonds, you're essentially thinking that you're going to get a recession, they're going to cut rates, the whole nine. But that could come a year from now, could even come 2 years from now. And in that time frame, there could be other opportunities. There could be a risk on regime in that time frame as well. And you just want to make sure that capital is allocated properly. If you're buying gold, you're buying bonds right now, it's just too early. We're not seeing it.
This is the beautiful thing about the hard landing and soft landing, right? To understand this, I'm talking to the listeners. You want to believe the markets are such a simplistic playground with two binary outcomes. I understand that. Most of you listening come from a simp mentality. Maybe, hopefully, you're not simps anymore, but you have this idea where if we're in a hard landing or a soft landing, and there's some truth to that. Don't hate on that. There's a power to that mentality to a degree. And what I'm about to tell you is why these simple individuals get caught up in the market thinking they arrive with this mentality, believe it's wrong, and then fight it, trying to figure out like, oh, it must be more advanced. It must be there must be some formula I don't know, some indicator I don't know. There must be someone knows something I don't know, and I'm gonna try and analyze every indicator until under the sun until I figure it out. When in reality is, if it's not a hard landing, it's a soft landing until it's a hard landing. It's that simple. The reason the market's trading the way it is because it's a soft landing.
Right. And once it becomes obvious what it is, it's already too late.
Exactly.
Once everyone realizes, oh, it's actually the hard landing, bonds are already up. The trade has already occurred. And so that's why it's very important to watch bonds, watch the regimes, and see how everything develops. We've got our indicators that we tweet about all the time. We look at real yields, we look at break evens, we look at the yield curve, And so that's something we're going to continue to look at, especially as this soft landing idea takes hold and people stop looking at that. Everyone's been looking at the yield curve being inverted. Oh, the recession's coming, recession's coming. Once we're in the thick of the whole soft landing idea, not a single soul is going to be looking at the yield curve. No one's going to give a shit about it. That's when
say it's broken.
That's when you got to look. That's when It's time to look at it. Time to look at bonds, time to look at break evens. That's when you're getting close. And that's exactly what's going to happen. I don't know when that's going to happen. Could be 6 months from now, could be 3 months from now, could be a year from now. Who knows? But we just take it day by day. We don't front run anything. We just trade what's in front of us. And I think we can wrap it up there. If you guys want to learn more, go to market-radar.com. You can sign up, come into our Discord. Our Discord's free as well. Just sign up for the newsletter. You can ask us any questions in there. We will happily answer. We also have a Twitter, so you can easily reach us if you got questions. We're happy to help.